Hello, my name is Richard Romey, President of ETF Portfolio Partners. I'd like to welcome you to our Market Outlook 2025 presentation. This is an annual presentation we do to help our clients better understand how we manage their investment portfolios. The presentation today has three objectives. First, I'll provide an overview of ETF Portfolio Partners and update you on the firm. Second, Will is going to discuss how the election could impact the markets, the economy, and subsequently your portfolios. And then finally, Nick, our Chief Investment Officer, is going to provide a detailed analysis of how our portfolios are currently allocated, along with our outlook for 2025. But first, a quick update on the firm. 2024 was an exciting year for us. We celebrated our 20th anniversary of serving clients. We founded the firm in April of 2004, and we certainly couldn't have made it without you, so thank you. We appreciate your trust and confidence over the years. Our assets under management reached $370 million. That's a number we have to disclose annually, and as I like to tell clients, we have the resources to where we can manage your portfolios and provide all the services you need, but we're not so big that we don't answer the phone when you call. We work with clients in 23 different states, and again, I like to point that out because we always get calls asking if I can work with someone's brother or sister in another state, and certainly we are a national firm, we can do that. And perhaps the most exciting news is exchange traded funds, the investment tool that we use to manage all of our portfolios, reached $10 trillion in assets, a monumental achievement for an investment vehicle that has only been out there a little over 30 years. So when we started this firm 20 years ago, we had three goals in mind. First, we wanted to be a portfolio manager. That is, we wanted to manage our own portfolios based on proven strategies. We wanted to control the process. Second, we wanted to always understand and know our clients' goals. We could have the best portfolios, but if we don't know and understand your goals and get you aligned with the correct portfolio, then it really doesn't matter. And then finally, we want to help you stay invested. After 40 years in this industry, I know that time in the market is key to success. I know that sounds like a cliche. It's used all the time, but it is accurate. So what we do is we provide a monthly newsletter, a detailed quarterly newsletter. We do updates continually for our clients, and then we do meetings like this to keep you informed as to what's going on to help you stay in the market. So again, we're going to touch on all of these over the next few minutes during my presentation. First, let's look at the incredible growth we've seen in exchange-traded funds. If it wasn't for the creation of ETFs, this firm would not exist. The name of the firm, ETF Portfolio Partners, comes from ETFs in exchange-traded funds. In 2010, there was roughly $8 trillion in ETFs. Today, there's over $10 trillion. Investors have voted with their dollars, and they have voted ETFs as a better investment vehicle. And it's not just investors and institutions, the United States government as well. During COVID, the depths of the COVID panic, the Federal Reserve stepped in and used bond ETFs to gain quick access to the bond market and help stabilize it. So clearly, exchange-traded funds, as we have always talked about, are an idea whose time has come. Why are ETFs so popular? Why have they grown so much? Well, it's really two reasons. The first is they offer a unique, innovative, investor-friendly structure. If you think about it, before ETFs, most investors relied on mutual funds. Mutual funds were created in the 1940s, and that same outdated structure is used today. ETFs, in contrast, were created with an innovative structure that allows investors to easily buy and sell shares. The structure makes ETFs more tax efficient. The structure makes ETFs lower cost in most cases than mutual funds. And also the structure separates the activities of investors buying and selling shares from the underlying portfolio. All of these are tremendous benefits. But I think the most important part is that ETFs, the majority, are index-based. And indexing is an investment strategy that actively managed mutual funds have a difficult time trying to beat. Now, there are certainly some actively managed ETFs, and we're seeing more of them come on the scene, but all of the ETFs we use are index based. So, this is my vision or my view of what active portfolio management is when you look at a mutual fund. It's like looking for a needle in a haystack. So, here we have our haystack, which is the stock market, and we have our fund manager there diligently digging through, trying to find the next winning stock. Well, indexing, instead of digging through looking for the needle in the haystack, we simply buy the entire haystack. And another way to look at it is like this. Let's assume that this haystack represents the total US stock market. Since 1926, 26,000 different stocks have traded, creating 35 trillion in new wealth. That's wealth that all of us as investors have shared. That works out to about a 10.5% annualized return from 1926. And this is a number we hear frequently, right? The stock market averages about 10 to 10.5% per year. But the reality is there are not 26,000 stocks out there today. So clearly, a lot of these stocks have gone away. They haven't returned 10.5%. And when you dig down into the numbers, you find that the reality is very few companies drive the market higher. In fact, approximately 90 companies have accounted for half of that $35 trillion in growth. So, carrying through on our analogy, those are the needles in that haystack that you had to find. You had to own those. A little over 1,000 stocks accounted for the entire 35 trillion. So the question is, what investment strategy allows you to know that you're always going to own those stocks which are driving the market higher, the stocks which are changing and expanding as the economy goes through different cycles? Well, the answer is indexing. We see that quite clearly in this chart. So this chart shows the top 10 holdings in the S&P 500 index since 1990. So it shows it by decade. So for example, in the top left corner, if you own the S&P 500 index in 1990, an investment vehicle tracking the S&P 500 index, your portfolio had 2.9% in IBM, 2.9% in Exxon, 2.3 in GE, and all the way down to Coca-Cola, 1.4. Now, there was another 490 companies, but these were the top 10. But look what happens by 2000. You still own the S&P 500 index, but you no longer have IBM in the top 10. IBM during the 90s had a dismal decade. It went down in value. General Electric was one of the top stocks to own. It was driving the market higher, and it became a larger and larger portion of your portfolio. I'd also notice lower in the top 10, you've got Microsoft. So we start to see the economy shifting to a technology-based economy, and Microsoft is filtered in the top 10, into the top 10. Now look in 2010, you still own the same investment, the S&P 500 index. Exxon is a top holding, but look, Apple is at 2.6%. Microsoft is at 1.8%. It's moved up to number 3. General Electric is still in there, but it's sliding down. And now, in 2024, you still own the S&P 500 index, but your top 10 holdings look nothing like they did in 1990 or in 2000. What you've got is Apple, NVIDIA, Microsoft, Alphabet, which is Google, Amazon, Meta, which is Facebook, Tesla. What you have are the top companies which are driving the market, and they're primarily technology based. So as new technologies have come along, as the economy has shifted, your index captured it. So the benefit of owning an index is that you're always going to own the stocks that are driving the market higher. If you own a cap-weighted index, as the value of the company becomes larger, it becomes a larger piece of your portfolio. Next, indexing gives you broad diversification with a single purchase. And then finally, since we use asset allocation to construct our portfolios, we want something which is going to accurately track the asset class at all times. Indexing is the only way to get that accurate asset class tracking. And so why ETFs have grown in popularity? Yes, they're a better investment structure, but also indexing is a better way to build portfolios. So now I'm going to take the next 5 or 6 minutes and just shift gears and talk a little bit about some of the market research that we look at when we build portfolios. So many people in this industry look forward. They look at forecasting corporate earnings, corporate prices, forecasting economic cycles and interest rates. If you turn on CNBC, most of what they're talking about is forward looking. And that's important. But I found when I was researching my book, Strategic Index Investing, I was doing a lot of research looking backwards, looking at historic market data, looking at daily returns, monthly returns, yearly returns for things like the S&P 500 index. And I found I became a much better investor when I spent as much time looking backwards as I do looking forwards. We use this quote quite a bit in our newsletters that history doesn't repeat, but it rhymes. That's a Mark Twain quote. And what it basically refers to is, yeah, people tend to do the same things over and over. And if you look at indexes, if you look at markets, aggregate market movement, it tends to do the same thing over and over. So we can learn by looking backwards at history. It provides perspective, helps you understand risk and return. So let's take an example. This is a chart that we put in our Q2 2022 newsletter. 2022 was a midterm election year, and the market was down when we published this. The market was down about 17%, and by market I mean the S&P 500 index. And so what this chart shows is every midterm election year since 1958. That's along the left-hand column. The next column shows the date that the S&P 500 index made its low in that year, and then the next is the low of the year. The first thing that jumps out to me when I look at this chart looking backwards at the market is that midterm election years tend to have some pretty nasty sell-offs. You can see 1962 down 26%, 1966 down 22. In fact, if you average all those numbers, you see that the average loss at some point during a midterm election is down 18.7%. The other thing you notice is that when the market makes its low, it typically does it before the election. In all but 2 of these years, the market hit its bottom prior to the November election. So the final part that jumps out is what happens 1 year after it reaches that low. Well, it's a tremendous return the majority of the time. So if you look in 1958, up 36%. The next year, 4 years later, up 32%. And if we average that, the average is 31%. So that's about 3 times what the S&P returns in an average year. So we put this out not to try to predict the future, but to add perspective. And when we put this out in the second quarter of 2022, we said the following. We think that the market will probably bottom sometime late summer, early fall before the election. And we think that once it's made that bottom, we expect the next 12 months to be good based on history. And it turned out to be just that. The following year was up 18.2%. And again, not predicting, adding perspective. Another one that we put out, this was one that we put out in our newsletter during the depths of COVID. We put it out mid-March 2020. And if you remember, the market was down 33% at its low during COVID. But more importantly, what this chart shows on the left-hand side is the bottom, the date the market reached the bottom. The next column shows the percent decline since 1950 of every decline of 25% or greater. So the first thing that jumps out at me on this chart is the market doesn't have a 25% decline very often. There's not that many of them. But when it does, the next 1, 3, 5, and 10-year period tend to be very good. So we put this out in mid-March, and the S&P 500 was down about 28 or 29%. And we clearly didn't know what was going to happen the next 1, 3, or 5-year period. But what we said was, historically, when the market drops 25% or greater, it's a good time to increase your equity allocation. And we recommended that if we had any clients who could take short-term volatility, higher short-term volatility, it could be a good time to increase your equity allocation. And a number of them did just that. And we rebalanced to increase the equity allocation. Well, 5 years later, almost 5 years later, will be 5 years later in a few months in March of 2025, which in and of itself is hard to believe. We've had a gain of 101%. So once again, this chart was not trying to predict the future. It was adding perspective. And since we know that history doesn't repeat, but it rhymes, it gave us the confidence to know that it could be a good time to enter and increase the equity allocation. So one more of these is the S&P 500 index again. Every time since 1950, when it was up 25% or more, what did it do the following year? So the first column is the year that the market was up 25% or more. The second or middle column is how high it was. So in 1954, the S&P 500 gained 45%. And then the far right column shows what happened the next year. Well, a lot of people believe that after the market has a really good year, that the next year tends to be down. Well, when we look back in history, we see that's not true. It's actually the opposite. In fact, 80% of the years following a year when the S&P was up 25% were positive. And only 2 years when it was negative, 2 of the 3 years, it wasn't even negative by double digits. So again, this chart really adds perspective. The other thing that jumps out at me is the fact that the market goes up 25%, a lot more than it goes down. If we remember the chart we just looked at, the market's been up 25%, more than twice as many times as down. Now, in 2023, the S&P 500 was up 26.3%. What's it going to do this year? Well, here we are in mid-November, and the S&P is up about 20%. So my guess is, unless something happens, something major happens to push it down, we're going to have a positive year, and this repeating cycle will continue. One other way you can look at historical statistical evidence is to help gauge or understand when you might expect a correction to happen. This chart goes back to 1948, and it looks at how frequently the S&P 500 index has a pullback or correction. So we see that on the far left, a 5% correction in the S&P 500 index occurs about 3 times a year. A 10% correction occurs about once a year. A 15% correction or more occurs about every 3.5 years. And a 20% correction occurs about every 6.3 years. Of course, a 20% correction would be an official bear market. So what we can use this chart for is to look and add perspective. So first of all, if the market drops 5%, 6%, that's normal. Second, when we look at the 10% slot, it's been roughly a year since we've had a 10% correction, October of 2023. So we're probably due statistically. Now, the excitement over the election, clearly the market's running up, tells me that we probably won't have the 10% correction for the next couple of months. But there's a good chance, I would think, by sometime early next year, before mid next year, you'll see the 10% correction. If the election had been closer and the election results were not as clear, my guess is we would have had a 10% correction probably within a few days of the election. So again, this just adds perspective about how frequently market pullbacks occur, and they shouldn't surprise you.
Hello, my name is Will Romey, and today I'm going to be covering the 2024 election and some of the economic policies that we anticipate could affect the stock market the most over the next 4 years. Then I'm going to touch on the fact that we currently are in a bull market and show a little bit of history of bull and bear markets in the United States. And then I'm going to end with inflation and where we're currently at. This chart shows the last 10 presidential elections that we've had and how the S&P 500 has performed around elections. What it shows from left to right is the day of the election day return, the winner, the political party of the winner, the time it took to announce the winner, the next trading day returns for the S&P 500 after the winner is announced, and finally, the 30-day later returns of the S&P 500. A couple things to note here is that the election day return tends to be very positive. 8 out of the past 10 presidential cycles has seen a positive election day return. Investors tend to be optimistic when they're standing in the polls and waiting to see if their preferred candidate won. The complete opposite happens the next trading day. Only 4 out of 10 of those days has seen a positive return in the S&P 500. Investors can certainly be emotional at times, and during presidential elections, emotions are very high. A lot of short-term volatility is the result of emotions, and you certainly see that play out around presidential elections. Now let's take a look at what happened this year. As everyone's well aware, Donald Trump won the election, and the next trading day saw the best return for the S&P 500 after a presidential election. It gained over 2.5%. A big part of that is because it only took one day to find out who the winner was. Before the election, plenty of people were talking about and guessing that we might not know who the winner is for days or even weeks later. That caused a lot of uncertainty within investors. And when that certainty came and we saw who the winner was, and we then could kind of have an idea of what the country's policies might look like over the next 4 years, investors really love that, and they love the certainty of knowing, because something that is true is that investors hate not knowing. But that 2.5% gain did not happen everywhere throughout the stock market and certainly global equity markets. What this shows is the difference performance by asset classes the day after the election. The total US stock market gained more than 2.8%. It had an incredible day, but small cap stocks did even better, more than doubling that, gaining 6% on the day. That's a clear indication that investors are optimistic that Trump will come in and lower governmental regulation as well as lower the corporate tax rate. That's an environment where small cap stocks can really exceed. One thing to point out on something that did very poorly the day after the election is the international market. That's a clear indication that investors are worried about what the tariffs could do to international equities, especially countries that see a lot of exporting to the United States, and how that could affect international stock prices. The 3 policies that I want to cover are Trump's plans to lower the corporate tax rate, cuts to regulation, and increasing tariffs. These are 3 that we think have a fairly high chance of actually happening based on his first administration, first term, as well as what he's said this time around on the campaign trail. This chart shows the corporate tax rate since 1952. It started above 50% until Reagan came in and cut taxes down to about 35% for corporations. It stayed around that 35% level until Trump's first term, where he cut it to 21%. And his proposal this time around is to cut it even further to 15%. Now, whether you agree or disagree that corporations should pay more taxes, it's a fact that when they pay less taxes, they keep more of their revenue, their profits go up, and that reflects in their stock price valuation going up. It's definitely a bullish indicator for the stock market, especially small cap stocks as well. Now let's talk about corporate regulation. There's certainly a fine line between cutting regulation. You do not want to question whether your water is safe to drink or your food is healthy or your car is safe to drive. But you can also have over-regulation, and over-regulation can stop new business development as well as innovation. And so there's a fair balance to be had. This chart shows the cumulative economically significant final rules published by administration in their first year. Reagan only published one economically significant rule. He was the king of deregulation. Trump is second on this chart, showing that in his first year of his previous administration, they did not implement a lot of significant final rules that would have an economic impact. This goes with his campaign promise of cutting regulation. Whether you agree or disagree, investors certainly are viewing it as a bullish sign for equities. The last policy that I want to cover is the potential impact of tariffs, especially tariffs on international stock. No surprise that higher tariffs could be bad news for international stocks, especially those that export a lot of goods to the United States. Chinese stocks, for example, in the emerging market category. They could also impact American sectors that rely heavily on international trade. And all in all, they just introduce a lot of uncertainty into the stock market. As we've talked about before, investors hate uncertainty, and tariffs could lead to a trade war that just expands on that uncertainty. And so it's seen as a very bearish indicator, especially for the international markets. Now I want to switch gears and just kind of show you this chart right here. It's the S&P 500 overlaid all of the previous presidential administrations that we've had going back to FDR. Blue is representative of a Democratic administration, whereas red is representative of a Republican administration. So we've had a healthy mix since FDR of Republican leadership and Democratic leadership, but the overall theme of the S&P 500 is that it goes up over time. No matter what the laws are, what the current policy is, American corporations are amazing at innovating and adjusting and making profits grow. We believe in the American economy, no matter who's president. And so we have faith that over time, stocks will continue to go up as innovation increases. Now I want to switch gears and talk about the fact that we are currently in a bull market. These are set terms that do have definitions. Just to cover them real quickly, a bull market is periods of high optimism. They start when the markets rise 20% from recent lows. It's a state of expansion in the economy, and they usually last about 7 years. A bear market is the opposite. They are marked when markets fall 20% from recent highs. It's a state where the economy is contracting and the average length is only 1 year. This chart shows the history of bull and bear markets in the United States. The bottom half of the chart represents every bear market that we've had, while the top half of the chart represents when we've been in a bull market. Something to note here is that we are either in a bull or a bear market at all times. There's no purgatory for stock markets. It's either bull or bear, one or the other. Bull markets tend to last a lot longer, as you can easily see from this chart, with the longest lasting over 12 years. That was from 1988 to 2000. And it was a period where we had very low corporate taxes as well as low regulation. And also, there was technological innovation happening. There was a new piece of technology called the internet, which some people said might change the world. 24 years later, it has changed the world. And it was just a period of very high optimism about the future. Now let's take a look at our current bull market. It turned 2 in October, on October 13th. The total return so far is 67%. And so it's still a very young bull market. If you remember from the previous slide, the average length of a bull market is 7 years. That's not to say that there's going to be 5 more years of this bull market, but it is an optimistic signal. So reasons why the bull market could last. First, the new administration is certainly very business friendly. Trump does watch the stock market very closely. Corporate profits are still extremely healthy. There are currently advancements going on in technology. AI is going to potentially advance us into the next century. People are very optimistic about AI. And finally, the underlying economy is very strong. There's low unemployment rates as well as low inflation coming down. Talking about inflation. This is a chart showing inflation expectations softening over the past 2 years, while people are still citing high prices for worse personal finance. It's a big reason why people cited the economy as their reason for voting this year. The line in black shows the year ahead inflation expectation. It peaked in 2022. That's when inflation peaked. And since then, it has come down to around the Fed target of 2%. The red dotted line represents the percent of consumers who cited high prices for worse personal finance. These two lines track extremely closely until inflation spikes, and then the red line stays high. That's because while the rate of inflation is falling, prices are not falling. It simply means prices are not rising as quickly. And so prices are sticky. Once they get to a certain point and people are still buying them, companies are not really incentivized to lower the prices. And so we're going to be experiencing these sticky prices for the next couple of years. And it's why a lot of people are still feeling the effects of inflation, even though the rate of inflation is now around the Fed target 2%. In summary, the election was difficult, but we are through it, and Wall Street does seem to be embracing some of Trump's policies. The bull market still has plenty of room to run. There is advancements in technology that can carry it forward, and the economy remains very strong, but prices do continue to be sticky. Thank you.
Hello, everyone. Thanks for joining us. My name is Nick Romey, and I am the Chief Investment Officer here at ETF Portfolio Partners. And today, what I'm going to be discussing is portfolio design and construction. You'll be able to kind of pull back the curtain a little bit and see how we design the portfolios that you're all invested in. So let's get started. I wanted to start off by going over a concept, simple things that can be deceptively complicated. And starting off with that, right, is the easiest one imaginable. 1 + 1 = 2. At the base level, we all know what 1 + 1 = 2 is, right? It's a very simple idea. However, it was not conclusively proven until the 20th century, and it took over 350 pages of complex mathematical formulas just to indeed come to the decision that yes, 1 + 1 does equal 2. And so, right, while things can be simple and very natural when you first look at them, the more you dig down, the more complex they can become. Another one, this is one that has stumbled philosophers for hundreds of years, left and right, right? We all know what left and right are, but try explaining that to someone who has no idea of the concept. It simply can't be done. We know, right, a left hand can't go in a right glove. They are, by definition, different, yet they're needed to explain one another. And again, philosophers have gotten together and come up with a 400-page book promptly titled The Philosophy of Left and Right if you would like to learn more about this concept. And then finally, where I'm getting to is asset allocation. Sometimes the financial industry does a poor job of really explaining things, and they make it a little too simple, in my opinion, right? 50-50 allocation, 50% stock, 50% bonds, or conservative mix or lifetime mix, right? Very simple ideas. But underneath that is the portfolio construction and design that actually goes into it, and right, the things that we work in every single day, however, are a little bit more advanced. So looking at a visual representation, you have the client's portfolio, obviously divided between stocks and bonds. That's asset allocation. Where we spend a lot of our time is in what's known as sub-asset allocation. And all sub-asset allocation really is, or sub-asset classes, is looking at a large group of stocks and then segmenting them into different smaller buckets in order to look at their risk and return series, because each of these different buckets will move differently at different times. And that's why you want to all have them in your portfolio. They add diversification benefits, right? You don't want everything in your portfolio going up and down at the same time. That's not diversification. Quantity is not diversification, but having negatively correlated assets that are protecting the portfolio at any given time, that's diversification. And so these sub-asset classes are a way to do so. And an example I used on Saturday at our presentation was the idea of a Rube Goldberg machine. For those of you who don't know, Rube Goldberg was a famous American cartoonist known for kind of creating these chain reaction machines used to solve a simple task, right? Like using a napkin. Here's a self-operating napkin. And I thought it was a really unique idea to look at portfolio management from the lens of this Rube Goldberg machine, because That's exactly what we do, right? The sub-asset classes and how we allocate in those sub-asset classes is very much so like all the mechanisms going on in a Rube Goldberg design. However, the simplicity of it, right, that 50-50 mix or a conservative mix, that's the napkin. And so this kind of, peels back and sees how we look at portfolio construction. There's a lot of moving parts, but they're all necessary to that end goal. Here it's moving a napkin. With us, right, it's creating long-term portfolios that optimize return given the level of risk. And the first sub-asset class we can break down is US equity. So again, we're looking at stocks and then looking at US-based stocks. And the first sub-asset class we're going to go over is something called size, sometimes referred to as a size factor. And again, right, with any sub-asset class, it's a way to characterize stocks based on certain fundamentals they hold. And so with the US size factor, what we do is we look at companies based on their market value. So large cap companies are going to have a market value of greater than 10 billion. Mid cap companies are going to have 10 to 2 billion in market value. And then small cap companies, we consider anything less than 2 billion in market value. And when you break it down, right, if you were to add up every single publicly traded company in the United States, you'd find that it's worth about $59 trillion. Of that 59 trillion, roughly 90% or 54 trillion lie in large cap securities, with the remaining 5 trillion being broken up between mid and small cap. And so when you're designing portfolios, what you always want to start with is a baseline, an idea of what to work with. And so we use that market weighted portfolio as our baseline. And that's what's represented in blue. As you can see, again, the allocation for size in the United States, 90% in large cap, 8% in mid cap, 2% in small cap. And then the green here, that represents how we're currently allocated in our portfolio for US equity. And the first thing that jumps out of the page, right, is that we're underweighting large cap securities at the moment and slightly overweighting mid and small cap securities. Now, this was a change we made about 8 months ago in anticipation of essentially the large cap movement kind of reverting to its mean and seeing some small and mid cap overperformance more recently. And that has come to be true post-election. And again, the reason you do this is because these different size segments are going to be acting very differently during different stages of a market cycle, during different stages of an economic cycle. And so by allocating toward these different segments, you're essentially increasing portfolio diversification. Again, you want things in your portfolio that are not all moving up and down at the same time together, but rather you want things in your portfolio where, let's say, if large caps are moving up, maybe small caps are coming down. But again, that's diversification because when large caps go down, small caps tend to benefit, and thus, right, is cushioning the downside risk in the portfolio. And another thing I wanted to point out is that large cap securities have been overperforming mid and small cap for about 5 years now. As you can see, cumulative return over the last 5 years for large cap securities is around 101%. Lagging behind that is mid and small cap securities. But what's interesting is that if you look over the last 25 years, right, a more extended time horizon, mid and small cap companies tend to do better. And so while large cap has outperformed in the near term, I'd say, I think we could definitely see that reversion to the mean effect because, right, all this is looking at statistics, historical averages, and seeing, in terms of their distribution, where they fall and where we should allocate to. And so for that reason, again, and we'll go into some more detail, and I know Will talked about this, but with the election as well, that's being potentially bullish for smaller companies. And so that's why we decided to make these changes. Now, the second way you can classify US-based stocks is by something referred to style or a style factor. And this is a way to group US companies based on where they are in their business life cycle, the fundamental valuations that drive them, what they trade at fundamentally wise, and then the type of business activity they're involved in. And what you'll see is there's really three main styles that we look at: growth, value, and core. Growth or growth-based companies. These are companies in faster growing sectors and industries. You can think of that like data computing, artificial intelligence, electric vehicles. These are companies that are going to be focused on rapid business expansion, right? Rather than paying out a dividend or not necessarily growing as much, they're going to take all their net income at the end of the year, plow it back into the company to continue to grow, hence the name growth stocks. What you also tend to see in this area is a lot of mergers and consolidation in these industries, right? The younger industries go through consolidations, and then by the time they mature, there's very few companies in that pool. So for those reasons, right, growth stocks tend to be a little more volatile compared to the other end of the spectrum, which is value-based companies. These are companies in more established industries. You can think of materials, industrials, a lot of healthcare, energy companies fall in here. And what they do, right, is they're focused more on delivering value to shareholders through the form of dividend payments. They maybe don't have as much growth prospects in the future, so they'd rather return capital to shareholders through dividends. But for their lack of growth prospects in the future, what you tend to see is they trade at lower valuations, lower price to earnings, lower price to book ratios, hence the term value-based companies. And for those reasons, right, that's why you tend to see less volatile companies acting as value-based. And so, right, those are the kind of the two outlier styles, I'd say. And then the third style is what we refer to as core, US core. And these are simply companies that aren't exhibiting large, overwhelming characteristics of growth nor value. This tends to make up a majority of the market, with the exceptions being those growth and value pure plays is what I would call them. But core is another style segment we look at, sometimes referred to as blend, which is why we have that blender icon as well. And then again, right, because sub-asset class allocation is all about separating companies into smaller groups so you can look at their return frequencies. That's exactly what we did here. So the blue on the graph represents US stock market normal weightings for style. So if you were to just pull every single company in the US, this is how it would line up in terms of growth, value, and core. And then the pink obviously representing where our current portfolio is allocated to. And what I want to note is what I would consider this allocation for ETF portfolio partners to be a very neutral allocation, right? We're not making any tactical decisions in terms of where we want to be overweight growth or overweight value. A few months ago, we were overweight large cap growth securities. We did this simply because the valuation was very attractive, considering the run-up growth equities had during the first half of the year. However, before the election, right, with a lot of uncertainty, not knowing what style component would outperform which, we wanted to move to a more neutral position. So again, we rebalanced our portfolio, we reduced the value-based exposure and got back to that market neutral weighting. So moving on from US-based companies, we can also look at international-based stocks and then segment them that way. And so sub-asset class number 3, we would just refer to this as foreign markets, international, and there's really two different ways to group these international companies, and we do it by economic activity, one being developed markets, the second being known as emerging markets. Developed markets, these are countries that have generally larger economies. They're going to have more efficient capital markets and financial institutions. You're going to see less government involvement when it comes to monetary policy, right? Interest rate decisions, as well as currencies. You're not going to see countries trying to influence their own currency in developed markets as much as you would the other. And so, for that reason, we would classify, including the United States, countries such as Japan, Europe, Australia, Canada, Germany, these would all be considered developed markets. On the other end of the spectrum, you have emerging market economies. These are smaller economies. Maybe one day they will become developed markets, but for the time being, they just simply aren't there. Investors simply, don't necessarily trust them as much as they would developed countries. Maybe that's because their government is going through changes, right? There's possible complete government or political change happening at the moment. Maybe they're influencing their currencies and their financial markets more than other investors around the world are willing to accept. And for that reason, they tend to trade at lower premiums, right? They tend to trade at higher premiums, essentially meaning they're a little more risky compared to developed markets, right? So you have to pay more in order to have investment there, right? Because with every investment in the entire world, Return has to be a function of risk. Emerging markets are more risky, so you would assume their return or expected return would imply a higher amount compared to developed markets. And for these emerging markets, we would classify countries such as China, India, Brazil, Mexico, South Africa. There's a lot of them. I would include Russia as well as an emerging market. But again, just a way to categorize different companies around the world based on how they act at different times during different market cycles. So just like we did with the size segment and looked at the total value of the U.S. stock market, if we were to take every single publicly traded company in the entire world, add them into one big pool, and then see how much that entire pool was worth, you would find the value is around $100 trillion. Looking at the breakdowns now of how each developed and emerging market represents in that global market portfolio, what you're going to find is that emerging markets, not including China, hold around 8% weight. China alone holds around a 3% weight. Developed markets, not including the United States, holds roughly 30%. And then the US holds the other 59%. And what I wanted to point out here is that if you look at the last one below, the S&P 500, the 500 largest companies in the United States, just the 500 largest out of the 3,700 that trade in the United States, represent more than half of the entire global market share. So the entire worth of the global stock market, 51% is represented through 500 companies in the United States. Not including the 500 companies in the United States, those other 3,200 publicly traded US companies represent another 8% share in that global stock market portfolio. So this leads us to, right, when we hear clients say, oh, I'm worried about the dollar losing its reserve currency status or the US government defaulting on its bonds, until this picture changes and until the US is not the financial capital of the world, the dollar will not lose its reserve status, its base status. Investors flow to U.S. Treasury bonds during times of economic hardship because they're guaranteed and backed by the full faith and credit of the United States government. The U.S. has never defaulted on any of its debt, nor do I believe it ever will. For those reasons, right, and just looking at market share alone leads us to believe the U.S. is nowhere near close to losing its status as the reserve currency of the world. It's just a fact that if you want to do global business, you have to work in dollars. And again, until that 59% in the US out of the entire stock market comes down significantly, that will hold true, right? The US will remain that reserve status of the world, the dollar. Breaking it down another way visually, if you were to look at two different portfolios, one on the right, that orange one, I would refer to this as a global weighted portfolio. You would find that the US, again, holds 59%. The developed markets, excluding the United States, 30%. And then emerging markets, right, China and Africa and India, they make up around 11% of that global stock market. On the left here is the ETF Portfolio Partners International Equity Allocation. As you can see, we're vastly underweight international equities compared to our overweight stance in the United States or the US equity component. And we've had this underweight international stance for quite some time. This is a tactical decision. This is a decision we've made about a decade ago to underweight international securities and overweight US companies for a few factors. Mainly, the biggest factor would be globalization, right? You can have exposure to international markets without investing in international companies. And the way you do this is by owning large US-based companies. Because if you think about it, Apple, Amazon, Meta, Tesla, right? These are companies that don't just do business in the United States. They do business around the world. So when you buy these companies, you in turn have exposure to international markets without actually having to hold international securities. That's our thought process. That's why we have an overweight status on the United States. And then along with that, right, the other thing it's just undeniable right now is the vast outperformance of US-based companies compared to international. So this is a chart of the last 10 years stock market performance, just cumulative stock market performance. And as you can see, right, with the COVID-19 pandemic in 2020, the US stock market has just simply outperformed developed and emerging markets hand over fist. There's no way to deny the US's outperformance. And so why is this important? Well, it's because the average American holds 30% of their portfolio in international equities. Around 50% of all 401ks have 30% in international equities. And that's because it's the global market portfolio, right? A lot of advisors and money managers will look at that global weighting and they'll say that's how you personally should be allocated in your portfolio. The problem with that, though, is that if you're not making tactical decisions and forecasting right, you'll find that you can lack in performance. And so an example we use is that international allocations, right? If you look at the average American that holds 30% and you're assuming 70% thereafter is in US companies, compared to a portfolio similar to ours that holds roughly 88 or 90% in US companies and 10 or 11% in international based companies, the outperformance of underweighting international for the last 10 years has been dramatic. As you can see, the underweight international portfolio is going to average somewhere around 12%, where the average or following the norm market weighted global portfolio is around 9%. The reason that's a problem is because if you look at $100,000 invested over that 10-year time frame, what you'll see is that the underweight international portfolio actually was worth almost 74,000 more. And so, right, while 9% is a very good return, and a lot of people are happy with 9%, it may not have been the right portfolio for them given what return they were trying to obtain, right? If you're in an aggressive portfolio, one that is either 100% equity or 90 or 80% equity, you're wanting to grow that portfolio as long as possible because the inferred time horizon is very long. So by underweighting international exposure in your portfolio, you've been able to do that. And so that's why we've had that change. Again, anything can happen in the market. International can begin to outperform. If we see that trend taking place and going forward, we will definitely make changes in our portfolio. I'll talk about it later, but developed markets are looking relatively attractive right now, something that hasn't happened in quite some time compared to the United States. So again, we'll see, but for the last 10 years, the US has had a very nice run versus international securities. So transferring over to the other asset allocation section, right, that other asset class, bonds, fixed income, whatever you want to call it. There's really two sub-asset classes we look at here. One is issuer, and that's simply grouping stocks by grouping bonds by who issues those bonds. And so, right, corporations, you could have a company like Apple that issues bonds because they don't want to issue more stock and dilute shareholders, so they issue bonds. We call these bonds corps or corporates. And you can also have governments that issue bonds, right? If the United States needs more capital, right, more spending, they're going to be issuing debt, and we call these bonds issued by governments govs or government bonds, governments. And the other thing you can do in terms of grouping bonds is you can group them by maturity. So going back to that Apple bond, right? When you buy an Apple bond from Apple, what's happening? Well, essentially, you're giving Apple money for them to use with the idea that you'll be repaid interest and then your principal at some later date. Well, that some later date is what we refer to as maturity. So long-term bonds are going to mature, or you're going to receive that principal payment back in later than 10 years. Mid-term bonds, you're going to receive that principal payment plus your interest back in 10 to 2 years. And then short-term bonds, you'll receive that principal and interest back in less than 2 years. And so the reason this is important is because it affects the price and return on bonds, both maturity and issuer. However, these are what we would call second-order effects. Interest rates are what we call first-order effects. And as we've talked about before, right, interest rates are inversely related to the return of bonds. So when interest rates are going up, as we saw over the last 3 years with the Fed battling inflation and raising interest rates, what happened to bonds? Well, the bond market experienced one of the worst bear markets in the last 3 decades, right? The last 30 years, because the Fed was raising interest rates so much, causing the return of bonds to continue to come down. We've seen over the last 3 quarters with the Fed lowering interest rates, the price of bonds has begun to recover along with the return. So maturity and issuer, though, are these second-order effects that also have a key part of what bonds will do when interest rates change. So in terms of maturity, longer-term bonds are going to be more sensitive to interest rate changes than shorter-term bonds. So when interest rates are going up, you would expect long-term bonds to underperform short-term bonds. and then vice versa when interest rates are coming down. The other thing you look at is issuer, and sometimes if they're non-government or corporate bonds, we look at this and we call it credit. Because, right, not every corporation and not every government is the same. Some have better capital in place and better credit amongst people who are willing to give them money, and for that reason, right, they have a status known as investment grade bonds. These are companies that there's a very good likelihood that they will remake that bond payment back to you, right, that IOU, and then you have non-investment grade bonds. These are bonds that the likelihood of default or not making payment is relatively high. And so ETF portfolio partners will always hold our money in investment grade bonds. And then on the government side, we always hold our money in US government. We do not hold our money in international bonds. The reason being is that bonds are supposed to play a conservative role in the portfolio, right? And so what we don't want happening is if we experience market volatility and the market pulling back, we don't want those bonds to act like stocks. And that's what you tend to see when you get into below investment grade or junk bonds and international based bonds as well. What you want to see is instead investors going into these risk safe assets, such as US government bonds and investment grade corporate bonds. And right, that's diversification again. You want everything moving in different sections at different times. So if you're in a 60-40 allocation and you experience market volatility, let's say the market corrects 20%, there's a good chance that 40% you have invested in bonds will rise as investors move into those bonds, thus cushioning the blow and not losing as much as you would if you were invested 100% in stocks. And this is a breakdown of how we're currently allocated in our bond portfolio. As you can see, between governments and investment corporate bonds, those government bonds are made up 100% of US government bonds. And then again, we do not hold any junk or non-investment grade bonds in the portfolio for the diversification benefit, as well as them being conservative investments. And then what you'll also see is the green shaded area shows how we are currently slightly overweight long-term bonds compared to short-term bonds. This is a change we've had in the portfolio for pretty much the entirety of 2024 in anticipation of interest rates coming down. Again, when interest rates are coming down, the return of bonds should be going up, with long-term bonds leading the way above mid and short-term bonds. And that's what we've seen over the last year. So turning and looking forward, let's see some key trends and themes in 2025 that we would expect, starting with US-based companies. Number one, less regulation and a friendlier corporate tax environment is going to be pro-business. When you tend to see these two effects in place, as the Trump administration has announced they're going to do, right? They're going to cut regulation and potentially lower taxes even more. That usually tends to benefit smaller companies, because these smaller companies don't have as good of access to capital, right? They may not be able to consolidate and merge as they would during times of less regulation. So what we would expect to see is these smaller companies outperforming larger companies during at least the first 2 years of a Trump administration. What we also want to talk about is the fact that long-term valuations have become extended for the US stock market above their historical average. When that happens, what you tend to see is short-term volatility, and volatility obviously could lead to short-term pullbacks in the US stock market. Given the run-up we've had over the last year, equities trading well above 20%, with the long-term average for the US stock market around 10%, I think it's only normal and probably healthy that we see some kind of short-term pullback at the beginning of 2025. However, when you look at the strength in the labor market, you look at rising corporate profits, you look at sustained economic health with positive GDP every single quarter this year, that all leads us to believe that we are going to see a continuation of the bull market throughout 2025. On top of that, when you look at history and you look at the strongest bull markets, such as the 1990s, what you tend to see is that when you have these strong economic numbers and you have rising corporate profits, and then when you interlay that with advancements in technology, those tend to be the longest lasting bull markets out there. And the advancements in technology, I believe we're experiencing right now are those of artificial intelligence. I think that's going to become a bigger part of the US economy and the global economy going forward. So again, for those reasons, I see the bull market running throughout 2025. Looking at international-based companies, without a doubt, tariffs are going to hurt foreign markets, especially emerging markets, right? Those smaller economies that are more dependent on exporting goods to the United States. However, developed markets are becoming relatively attractive, as I said before, compared to US equities. So at the beginning of 2025, what we could definitely see is portfolio managers, fund managers, rebalancing and moving some money out of US companies, probably primarily large cap US companies, and moving into these developed large cap companies instead, right? Repositioning, taking some gains off the table. So that's something to look out for as well for US developed markets. And then finally, with the bond market, right? Again, interest rates. Bond prices are affected by interest rates. Interest rates go up, price of bonds goes down. Interest rates go down, price of bonds go up. What we've seen over the last year is that the Fed has lowered interest rates by 75 basis points. It's expected that at the upcoming and final December Fed meeting, they're going to lower interest rates again by 25 basis points. That bring our entire interest rate cuts for the year to a clean 1%. So we do expect that coming, right? And that should help bond markets push bond returns higher. However, I wanted to talk on this topic of Fed speak for a moment. And Fed speak is just a way Fed officials express views to the market without actually coming out and saying it. And so if you remember Jerome Powell, the chairman of the Fed, when inflation began to become a problem and peek its ugly head, people were asking, what do you see of inflation? What's going on? And he just kept saying inflation is transitory. It's transitory. Don't worry about it, until obviously it wasn't. And then all the Fed officials, including Powell, changed to rates are going to remain higher for longer, higher for longer, higher for longer. That's all we heard. And now what we're starting to see in terms of Fed speak is this idea of a normalization in rates. And so I actually had the opportunity to go to the Kansas City Fed and listen to the Kansas City Fed president, Jeff Schmidt, give some remarks not too long ago. And he a couple times brought up this idea of a normalization in rates. I thought it was interesting at the time, but didn't think much of it until I listened to Jerome Powell's press conference after they lowered rates last Thursday. And he said, we are looking for a normalization in rates. And I started to think, yeah, okay, this is probably Fed speak happening in real time. And so what does a normalization in rates mean? Well, I believe that it means that we're likely to see lower rates than where we are right now in 2025. I think the Fed will continue lowering. However, I wouldn't expect them to lower around 4%. I think pre-COVID interest rates, if you look 2009 to 2020, where interest rates were close to or at almost 0%, I don't think we're seeing that in the future. I think the normalization in rates is going to remain around 4% level for an extended period of time. When you look at long-term interest rate averages, that's tend to be where they fall around that 4% level. In my opinion, it gives the Fed more flexibility to make changes and lower interest rates should we go into economic shocks. So that's something I would expect to see in 2025 is rates coming down, but not necessarily coming down to pre-COVID levels. And then finally, as always, right, and why you hold bonds in a portfolio, when the stock market experiences volatility and it goes down, what you tend to see is investors moving money out of stocks and putting that into the bond market. That causes the price and return of bonds to rise, helping a portfolio. And so should we see any short-term volatility in the near term, which is likely given the run-up that we've had in the US stock market and just global stock markets, what you should see is the price of bonds recover and the return of bonds begin to outperform. And so, right, those are just key things to look at in the bond market going forward. I know it's been a tough time for bond investors. However, I would say remain the course, hold steady. I think bonds are going to have a really good 2025.
In closing, I'd like to thank you for taking the time to watch this presentation. I hope it was informative and that it gives you greater insight into how we manage your portfolio and how we look at the market and make our decisions. I'd also like to thank you for 20 great years. It's been an exciting time as ETF Portfolio Partners has grown, and we're excited for the next 20 years. If you have any questions or would like additional information, please reach out to us. We look forward to hearing from you. Thank you.